If you're familiar with the term "history repeats itself," then you probably know what happens when you expect it the least. What happened during the 2008 crisis repeated partially during the Covid-19 pandemic, and most people do not even know it. For most people, the 2008 financial crisis was a nightmare. Millions of people lost their jobs, their homes, and their savings. But for a few, it was the greatest opportunity of their lives. Among them was Michael Burry. Burry was one of the first investors who saw the cracks forming in the U.S. housing market. While others were still blinded by the illusion of stability, he placed a bold bet, and he used credit default swaps to bet against mortgage-backed securities. When the housing market collapsed, Burry made hundreds of millions of dollars in profit. Fast forward to 2020, and history repeated itself in a way no one could have predicted. This time, it wasn't the housing market, but it was the entire global economy. And this time, the man who saw it coming was Bill Ackman, a billionaire hedge fund manager and founder of Pershing Square Capital Management. While the world was still underestimating the danger of COVID-19, Ackman was making his move in silence. He used the same strategy Michael Burry had used in 2008. He put his bet against corporate bonds using credit default swaps. But Ackman's timing and execution was so precise that his initial $27 million investment gave him a return of $2.6 billion in just a matter of weeks. Bill Ackman's success during the COVID-19 pandemic was because of his ability to foresee the economic devastation that the virus would cause. In early 2020, as the virus began to spread beyond China, Ackman recognized that the global economy was on the brink of a severe downturn. Governments worldwide were imposing lockdowns, businesses were struggling, and consumer spending was plummeting. The stock market, which had been riding a decade-long bull run, was poised for a dramatic correction. Ackman's prediction was not merely speculative. It was based on a deep understanding of the interconnectedness of global markets and the fragility of corporate debt. Bill Ackman even gave a TV interview where he said that the government should shut down the country for the next 30 days and close borders and keep only essential services open. And people should go back to their family and should focus on their health.
I do right now, though, want to bring in Bill Ackman on the phone. He took to Twitter today to urge the president to take more dramatic measures to stop the spread of the virus. Bill, I thank you for joining us today.
Thank you, Scott.
A number of ideas you put forth. I'm going to read one of them for our viewers to start. Mr. President, the only answer is to shut down the country for the next 30 days and close the borders, you say. Tell all Americans that you are putting us on an extended spring break at home with family, keeping only essential services open. The government pays wages until we reopen. I know from our conversations that you have been worried for some time.
He had studied how the virus was affecting the people and spreading rapidly among people. He knew that 1 to 2% of people were going to die because of this virus, and knew that as the virus would affect a huge number of people, then most people would lose their close elderly family and friends. His whole basis was what China had done in Wuhan initially. Initially, China had given a warning that they would close Wuhan, and 5 million people left China and dispersed into the whole world. For Ackman, it was enough to know that some people who were infected weren't having any symptoms, but they were carrying the virus and spreading it. When China closed Wuhan and people left China, Ackman knew that it was going to be a pandemic.
When China shut down Wuhan, they told people, 12 hours from now, we're going to shut down Wuhan. Well, what happened? 5 million people left Wuhan. And 5 million people dispersed around China, and 5 million people dispersed around the world. When I did the math, I said, the laws of probability tell me this thing is going to be everywhere. Everyone, 50% of the world is going to get infected. And I sort of rolled this thing forward, and I said, it's just a matter of time.
He knew that the lockdowns would start and that these lockdowns would be for longer durations. It's difficult for businesses to survive without revenue for that long. He ultimately knew that the world should be shut down for 30 days to get rid of the COVID virus. But governments at the time were hesitant to do that initially, and COVID lasted much longer. Ackman anticipated that the pandemic would lead to widespread defaults, particularly among companies with high levels of debt. His focus was mainly on hospitality, tourism, and retail business. His way of betting against these businesses was through the credit default swaps. I have already simplified and explained credit default swaps in this video. Make sure you watch it. Basically, credit default swaps function as a form of insurance against the default of a bond or loan. The buyer of a CDS pays a periodic premium to the seller, who, in return, agrees to compensate the buyer if the underlying debt instrument defaults. For Ackman, purchasing CDS contracts was a way to bet against corporate bonds without directly shorting them. If the bonds defaulted, the value of the CDS would skyrocket, resulting in substantial profits. Ackman's strategy was based on identifying the corporate bonds that were vulnerable to the economic fallout of the pandemic. He focused on investment-grade bonds issued by companies and industries that were particularly susceptible to the effects of lockdowns and reduced consumer activity. These included sectors such as hospitality, retail, and travel, which faced existential threats during the pandemic. Before we go further, let's understand what corporate bonds are and how they work. Corporate bonds are a way for companies to borrow money from investors. When a company needs to raise funds for things like expanding their business, building new factories, or developing new products, they can issue bonds. These bonds are essentially IOUs, I-O-U, that the company promises to pay back with interest. How do these corporate bonds work? When a company decides to issue a bond, they set the terms, including the amount of money they want to borrow, the interest rate, also called the coupon rate, and the time period maturity date by which they will pay back the money. The company then sells these bonds to investors. Investors can be individuals, mutual funds, pension funds, or other institutions. When you buy a corporate bond, you are essentially lending money to the company. In return for lending your money, the company agrees to pay you interest at regular intervals. This interest is called the coupon payment. For example, if you buy a 5-year $1,000 bond with a 5% per year interest payment, for 5 years, you get $50 as interest, and at the end of the bond's term at the maturity date, the company pays you back the original amount you lent them, known as the principal. Why do companies issue bonds? Companies issue bonds for several reasons, such as raising capital. Bonds are a way for companies to raise money without giving up ownership. Unlike stocks, which represent ownership in the company, bonds are a form of debt. The company owes you money, but you don't own a piece of the company. Sometimes, issuing bonds can be cheaper than borrowing from a bank. If a company has a good credit rating, they can borrow money at lower interest rates through bonds. Also, bonds can be structured in many ways to meet the company's needs. For example, some bonds can be converted into stocks, and others can be paid back early if the company chooses. What are the types of these corporate bonds? There are different types of corporate bonds, each with its own features. But today, we will focus only on investment-grade and high-yield bonds. Investment-grade bonds. These are bonds issued by companies with a strong credit rating. They are considered safer investments because the risk of the company defaulting is low. However, because they are safer, they usually offer lower interest rates. High-yield bonds, or junk bonds. These are bonds issued by companies with lower credit ratings. They are riskier because there's a higher chance the company might not be able to pay back the money. To compensate for this risk, they offer higher interest rates. One of the key bonds Ackman targeted was issued by Hilton Hotel, the global hospitality giant. Hilton's business model was heavily reliant on travel and tourism, so it was highly vulnerable to the pandemic's impact. As countries imposed travel restrictions and consumers canceled vacations, Hilton's revenue streams dried up, increasing the likelihood of default on its debt obligations. By purchasing CDS contracts on Hilton bonds, Ackman positioned himself to profit. Similarly, Ackman bet against bonds issued by other companies in the travel and leisure sector, including cruise lines and airlines. These industries were among the hardest hit by the pandemic, as global travel came to a near standstill. The bonds of companies like Carnival Corporation and Royal Caribbean Cruises, which had taken on significant debt to finance their fleets, became prime targets for Ackman's CDS strategy. In addition to hospitality and travel, Ackman also targeted retail companies struggling to adapt to the shift in consumer behavior. With brick-and-mortar stores forced to close and consumers turning to online shopping, many retailers faced insurmountable challenges. Ackman's bet against the bonds of companies like Gap Incorporated and Macy's expected that the pandemic would accelerate the decline of traditional retail. Ackman's CDS strategy worked very efficiently as the pandemic started. In March 2020, as the stock market experienced one of its sharpest declines in history, the value of the CDS contracts Ackman had purchased rose rapidly. The widespread fear of corporate defaults drove up the price of CDS, allowing Ackman to sell his positions at a significant profit. His hedge fund, Pershing Square Capital Management, made approximately $2.6 billion from its CDS trades during this period of just a few weeks. However, Ackman didn't just profit from the collapsing market. He also reinvested his profits. He anticipated that once the market reached its lowest, then the government or Federal Reserve would intervene to stabilize the economy. So, Ackman anticipated a swift recovery in asset prices. He used his profits from CDS trades to acquire stakes in companies whose stock prices had fallen a lot by the market sell-off. One of Ackman's most notable investments during this period was in Berkshire Hathaway. He saw the market downturn as an opportunity to buy shares of Berkshire at a discount. He also invested in other high-quality companies, such as Lowe's and Starbucks, which he thought would rebound as the economy recovered. Ackman's dual strategy of profiting from the market's decline and then capitalizing on its recovery shows his shrewdness in investing. By leveraging the profit from both sides, he was able to maximize his returns. Some people still complain that Ackman manipulated the market. But if you see his interviews before the pandemic started, whatever he said, it happened exactly like that. So overall, he could see the future of the financial markets during the pandemic. He acted, and most importantly, warned everybody, but nobody listened. This is how Bill Ackman profited from the COVID-19 pandemic. The story and method of Burry and Ackman are almost similar. They both saw what everyone else thought could never happen, and they bet huge money on their instincts and made life-changing money. If you want to know how Michael Burry figures out the potential crash of 2008, then give it a like, subscribe, and check out this video.